All right, welcome back. Joined now by Merrill and Bank of America Private Bank CIO Chris Hyzy. Stock's having a pretty good go of it. It's nice to see you back here.
You too, Scott.
Sound from the notes like you're pretty bullish. You expect earnings revisions to go up, productivity and margin protection, just the beginning. Oil prices not spiking, tariffs going to be quiet, financial conditions easier, tech leadership. Did I get that right? You're pretty bullish?
That's the ladder. That's the ladder we climb.
Yeah, all that has to go right?
Some degree of it. Not all of it together, but certainly unfolding as we head into 2026. And too much has been talked about negative surprises, and obviously so, right? I mean, there's been a lot of negative surprises, particularly what occurred over the weekend. But it hasn't impacted earnings to a level that everybody expected. It hasn't impacted the consumer to a level that everyone is expecting. And yet, we still haven't seen the price hikes from the tariffs, which we can't say that's not coming. Certainly, there's some signs of it.
On any of the things you mentioned, because someone could just come back and say, yet. We haven't seen the inflation from the tariffs yet.
Right.
We haven't seen oil prices necessarily react to what could potentially happen there yet.
Right.
But you don't expect any of that to be material.
Not material. And if you build a strategy off a yet, you've basically underperformed for a really long period of time.
Well, that's beset a lot of investors over the last couple of years. Right? I mean, when the Fed even started doing their hiking regime, well, we're going to have a recession. Well, we haven't had one yet. Never materialized.
That's right. Inverted yield curve. Never happened before that long of a period, but yet not go into recession. So you have to ask yourself, each step of the way, what is the resiliency factor? Has something really changed in this last few years? And we think the learnings coming out of a terrible healthcare situation called the pandemic, of what corporations had to do to get through that time period, they've kept those learnings and they've been able to maintain margins. And yet, what do we have now? Generative artificial intelligence, producing efficiencies, and still people are skeptical about it.
And you think earnings are going to be able to justify not only where the market currently sits, 22 point whatever times, and you could get multiple expansion?
Not yet in that cards, right? To that point where you can go from 22 to 23 or 24 times. Sure, you could in a blow-off top, right? But at the end of the day, it's really about profitable production. And that's coming in 26. You're not going to see it in third quarter and fourth quarter. All of a sudden, you're going to see massive positive revisions. But for fiscal year 26, that's what we believe.
And you're not, when you look at the events over the weekend that you referenced and the retaliation today and the way that the market has held up in the face of that, are you declaring that you think this is the extent of it?
No.
And no, you're not. No. Well, what happens if it gets worse?
Well, we've seen periods of time over the course of history that it's just not one event and it stops. So you can't expect further escalation. But the markets are telling us right now, particularly the oil markets, that there seems to be an antidote out there. And that means no further escalation as to what the worst case scenario is. Well, again, early days.
That's probably why the market reacted the way it did today, right? Because you send missiles towards a base, you alert people that the missiles are coming, you don't shut down the Strait of Hormuz as the other sort of I hate to say nuclear option because we're not really talking about like that, you know what I mean? But the market would look way different if that was on the cusp.
It would have been similar to the other precedents that happened over the course of time in history. And right now you're starting to see, I think oil at one point in time today was down 5%. So the question is 30, 60 days ago, did something get anticipatory up ahead of all this? I'm not a geopolitical strategist, but what I'm focused on right now is why is the market at 22 times earning right now? It's there because of the companies that make up the index. And is this a trampoline event overall for the tech sector to become the leader again? We think so.
It already has, hasn't it?
It has since April 2nd.
Well, that's what I mean.
But
that's why we're in 2% away from a new high.
Exactly. And but if you look at 1 year ago from today, it's almost a round trip. The rest of the market has helped up the leadership of tech. But now if tech takes that leadership again, that's where you get your move higher that people are not expecting.